Hi there, I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're diving into Lockheed Martin, the aerospace and defense juggernaut behind the F-35 fighter jet, hypersonic weapons, satellite systems, and more. With global defense budgets rising and geopolitical tensions in focus, how does Lockheed stack up today based on the fundamentals? We're going to break down Lockheed Martin's stock using our 5 key factors to determine whether it's undervalued, fairly valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. First up, is Lockheed Martin turning its investments into real value? Lockheed Martin's return on invested capital is 13.4%, which is healthy but slightly below my preferred threshold of 15%. Still, this shows the company is allocating capital efficiently, especially in a highly regulated, contract-driven industry. Now you might be wondering, based on previous videos, what about return on equity? I have chosen not to highlight return on equity, and here's why. Lockheed's return on equity is skewed by share buybacks that have reduced total equity to very low levels. This inflates the ratio in a misleading way. Next up, growth. Is Lockheed Martin delivering long-term performance? Over the last decade, revenue grew at a compounded annual growth rate of 6.4%. Net income grew at a CAGR of 4.4%, and earnings per share rose at a 7.7% CAGR, hitting $22.3 in the latest fiscal year. That earnings per share growth is particularly important. It reflects not only organic performance, but also the impact of buybacks and margin control. While these aren't explosive numbers, they're consistent and stable, exactly what you'd expect from a defense contractor that thrives on long-term contracts and steady government spending. Looking ahead, analysts project similar moderate growth, driven by a global increase in defense spending. And Lockheed's leadership in next-generation technologies, like hypersonic missiles and space systems. Does Lockheed have a healthy financial position? As of 2024, Lockheed holds $2.5 billion in cash and short-term investments and $21.4 billion in total debt. So Lockheed can't fully cover its debt with cash, but that's not unusual for a capital-intensive business like defense contracting. What's more important is how well the company can service its debt with ongoing cash flow. Now, the debt-to-equity ratio isn't a useful metric here due to Lockheed's aggressive share buybacks, which have significantly reduced its equity base and distorted the ratio. Instead, a more insightful measure is free cash flow to total debt. This tells us how much of the debt could be paid down each year from free cash flows. Lockheed generates $5.3 billion in free cash flow annually, compared to $21.4 billion in debt. That gives us a free cash flow to debt ratio of roughly 25%, which is well above the healthy benchmark of 10%. This indicates that despite high nominal debt, Lockheed has a strong capacity to service and reduce its liabilities through internal cash generation, a key strength in a cyclical industry. Even great companies can be poor investments if you overpay. So how is Lockheed valued today? Lockheed trades at a price-to-earnings ratio of 20, which is right around market average, but lower than key peer Raytheon at 42.3. It's also nearly identical to Northrop Grumman at 19.9, while Boeing's price-to-earnings ratio is currently negative due to ongoing losses. Now let's look at the PEG ratio. That's price-to-earnings divided by expected earnings per share growth. This gives us a PEG ratio of 2.6, which indicates a high valuation relative to Lockheed's expected growth rate. That said, some investors are willing to pay that premium for predictable defense sector cash flows, especially in volatile markets. Can Lockheed Martin defend its profits in the long run? Lockheed Martin's moat is all about scale, government trust, and technological edge. It's the largest defense contractor in the United States, with decades-long relationships with the Pentagon and allied governments around the world. Its intangible assets, from proprietary designs to mission-critical software, give it durable pricing power and high switching costs. Lockheed's moat is wide due to regulatory barriers to entry, massive capital requirements, complex intellectual property-driven manufacturing, and a valuable aftermarket service business. Defense is also a sticky industry. Once you're locked into a fighter jet platform or missile system, switching vendors is extremely difficult and expensive. Before we wrap up, you might have noticed the clean, detailed charts in this video. They're powered by Fiscal. If you want to upgrade your investment research, check out the link in the description for a 15% discount on Fiscal's premium tools. In my view, Lockheed Martin stock is overvalued, but still a long-term hold based on our 5 key factors. Lockheed's 13.4% return on invested capital is healthy, but slightly below our 15% threshold. Earnings per share has grown at a 7.7% CAGR over the last decade, which is steady but not explosive. With $2.5 billion in cash and $21.4 billion in total debt, they can't fully cover their debt with cash. But free cash flows cover roughly 25% of total debt, keeping leverage manageable. Lockheed's price-to-earnings ratio of 20 and PEG ratio of 2.6 indicate the stock is expensive relative to growth. Lockheed enjoys a wide economic moat, thanks to government contracts, their technological edge, and high switching costs. What's your take on Lockheed Martin? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.